Hey guys, what is going on? Welcome back to the portfolio. Again, I want to thank everyone out there for supporting the channel. If you guys do like the content, if you guys do like the video series, feel free to like, share, and subscribe. And if you are a subscriber, make sure to hit that bell button to get alerts and updates on all new content posted on the channel. For today's video, in response to a viewer on the channel, I thought I'd take a look at what a qualified versus an ordinary dividend is. It has very big implications at the end of the year when you have to pay tax on all dividend distributions. If you make quite a bit of money through dividends, you actually have to pay ahead as well. Pay money into the system quarterly to keep up on the tax rates. When you buy a dividend stock, however, there are some very key advantages of holding the stock for the longer term. So I kind of want to talk about that because I've changed the way I've traded a number of my stocks because of the tax implications. Up on screen here, you can see VOO. This is a Vanguard Sp 500 ETF. One of my favorite ETFs. You can see in the middle here, it's a very large market cap index stock, 103.44 billion for market cap. Has a very good dividend yield as well, 1.78. Historically, I think it's more around 2.2 to 2.5, but nevertheless, a very good income-producing, longer-term buy and hold indexed fund. These Vanguard funds have very low expense ratios as well. I believe this one has an expense ratio of 0.04, so very, very low. On Robinhood, you can buy and sell this stock for free. And I recently found out as well on my E-Trade account, I can now trade this stock for free as well. So you're not limited to just the Robinhood platform for trading these types of stocks. E-Trade also has the ability to trade Vanguard funds now for free. No commission trading on the E-Trade platform as well. But nevertheless, what qualifies a stock for a qualified dividend? So up on screen here, I have some different tax rates. You can see on the left is the tax bracket. On the right is long-term gains. That also applies to qualified dividends. And you can see a very big difference between the two categories. On the left there, for example, the lowest tax bracket, 10% and 15%. If you can qualify for your dividend, you can see it now drops to 0%. Likewise, for the 25 to 33%, 35% tax bracket, I should say, you're also dropping to 15%. So if you're on the bottom of that particular cohort there, you save 10%. On the top, you save 20%. And the highest tax bracket there, if you make more than $406,750 per year, you fall into the ordinary income tax bracket of 39.6%. But you can see on the right there, it falls to 20%. So you save almost 20% with that particular tax bracket as well. So what do you need to do to qualify your stock to have a dividend for the lower tax rate? It's very, very simple. There's a number of different parameters. It has to be a U.S. corporation or a foreign corporation that readily trades on a major U.S. exchange. If you're doing your trading in Robinhood, you already qualify for that first point. The second and the biggest one that will get you into trouble if you're doing a lot of day and swing trading. That's why I've kind of backed off doing day and swing trading with Portola, PTLA, as well as Ford F, because I'm always subjecting myself to shorter term capital gains as well as ordinary dividends instead of the qualified dividends and the lower tax rates. So the big thing we need to do is hold the stock for at least 60 days of the holding period. And you can think of the holding period as the 60 days before the ex-dividend date and the 60 days after the ex-dividend date. So it's a 121-day period. You have to hold the stock for at least 60 days out of that 121-day holding period. Again, 60 days before the ex-dividend date is when that starts, and then it ends 60 days after the ex-dividend date. So if you buy the stock early, 2 months in advance, you can sell off on the ex-dividend date, or if you buy the stock before the ex-dividend date to qualify for the dividend, as in a dividend capture, you then will have to hold the stock for 60 days thereafter before you sell off the lower tax rates. And again, those tax rates can be quite significant, 10% all the way up to 20%. So if you get a $100 dividend payment, instead of having to pay 40% if you're in the highest tax bracket, or 35 or 28, for example, you can now pay just 20 or 15%. So you're saving yourself quite a big chunk of money by simply holding the stock for a bit longer term. So that's why for my portfolio, Portola, I no longer do swing trading as well as Ford. Made quite a bit of money on both of those stocks, but I also had to pay a lot more in tax as well. So it has very, very big implications at the end of the year. You may think that your dividend income is quite substantial, only to realize later at the end of the year, you're paying back maybe 40%, maybe 25% of that back in tax. If you would have held the stock in the holding period just a little bit longer, maybe instead of doing a 1 month swing trade, you did a 2 or 3 month swing trade, you saved yourself 20%, or up to 20%, I should say. Most investors will save anywhere from 10 to 20%, but a very, very big thing to take into consideration. Definitely wanted to emphasize that with this particular video. There's been a number of viewers on the channel wondering why I don't swing trade Ford anymore, wondering why I don't trade Portola anymore, and that is the reason. I was paying a lot more in tax by doing those strategies and stocks that I hold for the longer term as well. If you have a stock that you're not holding for the longer term, you can swing trade without any difficulty, just realizing you'll have to pay a little bit more tax. But if you have a longer term hold like I did in Ford with very big tax payments, or excuse me, with very big dividend payments, if I start swing trading that stock, then I'll have to pay a lot at the end of the year. I'll have a very big tax payment as well. So to minimize that, longer term hold stocks, don't do any day or swing trading. Only do those on stocks that you're holding for the shorter term. And on those longer term buy and hold stocks, try to get very good dividend paying stocks that you can simply buy, hold for the longer term. You get your qualified dividends as well as your long-term capital gains for the preferred tax rates. So I hope that answers the question. For those few viewers who did ask that question, that's why I don't swing trade in Portola or Ford anymore, because of the big tax benefits of holding the stock for the longer term. Not only for the capital gains tax rates, you have to hold the stock for greater than 1 year before you sell off, or even for dividend payments, you have to hold for at least 60 days in that 121-day holding period. Again, it starts 60 days before the ex-dividend date and then ends 60 days after the ex-dividend date. So if there's any other ways of minimizing taxes, please let me know. These are the two biggest that I've encountered so far. And again, that's why I don't do any more day or swing trading in stocks that I hold for the longer term. So if you guys have any other great advice for taxes at the end of the year, please let me know. Always looking for ways in which to minimize tax exposure. Kind of with that, I'll end this video. Again, if you guys have any comments on this video, any questions, please let me know in the comment threads down below, and I'll do my best to get back to you guys as quickly as I can. So kind of with that, I'll end the video, and we'll see you guys next time.